Hey everybody, Courtney Smith here with our Wall Street winners for January the 31st. The bear market continues. So here we can see, we hammered this down here. Now, a week ago, I told you that we would probably rally, and I was talking about up into this 46, up into this zone here, 45 to 45.50, something like that here on the S&P. We didn't really do that until Friday. Friday we started the rally. So look for a bit of a rally, as I say, up into 4,600, 4,500 to 45.50, somewhere up in that area. We should see the market strengthen this week. Now, this is going to be critical because it'll make people think that the bear market's over, but it's not over. And we'll use that rally to short sell a lot of stuff. Now, we talked about these vertical bars here where there was too much selling pressure, and this was one of the key reasons why we were looking for a bull move here, a little bit of a rally. We can see here in the Dow was a little bit stronger than the S&P. Now the selling pressure is really collapsed. Buying pressure, not up at all, but selling pressure has collapsed. Now, this is very interesting. So we don't normally see selling pressure collapse and buying pressure not go up, but we're not really seeing that. I thought we'd rally this last week, but buying pressure did not enter into the market. So the bulls are not in control of this market. This black line is the ADX, and it's a trend indicator. So it's confirming that we're in a bear market. NASDAQ is the weakest of the three, but notice the purple predictor shows that the smart money is taking advantage of all these NASDAQ stocks that are on special. Okay, so once again, looking for a rally. Here in the NASDAQ, we'll probably get up around 14,800, give or take a little bit. So look for all of that to happen this coming week. So this week's going to look pretty bullish. Our seasonality indicator is still neutral. My flip to bullish is way up here. Doesn't look like we're going to hit that anytime soon. Utilities are normally bearish this time of year, or neutral, I should say, and so we just have them as neutral. Okay, this we have to stop at. So what's happened is that seasonality suggests we should have declined 1.5–2%, but instead we've declined, depending on the index, let's call it 10%. So the seasonality has gotten the direction right, but not the magnitude. The magnitude has been far worse than what we would expect based on seasonality. Now, last week, one of the reasons I thought we'd rally is because the seasonality was bullish, but it looks like we're going to it's still bullish here in the early part of the week. So look for strength here early in the week, and then notice from the beginning of February to the middle of February, we're back to bear market. And in fact, that bear market really lasts until the end of February. So we still have another month to go on this. Now, the fact that the market's down 10% when you'd expect more like a 2% decline shows that the market is weaker than normal seasonality. So we could easily see this market go down 20%-ish, something like that. One reason, money is bailing out. You can see here we actually hit a new low on the asset allocation, showing that money is leaving the stock market and going into bonds. But if it's in the stock market, it's going to less risky stocks. So money's flowing out of the stock market, but what money there is in the stock market is going to, let's call it consumer staples, utilities, all the conservative sectors. So that's changed. We're really focusing on what we call the pit bulls of the Dow. That's where we're focusing, not into all those sexy high-tech stocks where we have virtually none of those in our portfolio anymore. Global shares, look at this. They've broken all these lows because, of course, foreign economies are worse off than the U.S. economy. Yield curve continues to look at, we're up to where we were after the COVID crisis. I think we're going to continue to grind higher, not a sharp move up, but a grind higher on the yield curve. That's actually a bit bullish for the stock market. but it is bearish for bonds. Bonds, you can see here, have stabilized. So let's be very clear. Let's go over here to our indicators. Our indicators are all saying that we should see higher yields. CRB, higher yields. Gold, stable yields. DMARC still got to consider it saying higher yields. So that would mean that we would probably see yields go from about 180 up to 2%, something like that. But why isn't it weaker? And the reason is I already showed you. The asset allocation shows that money is flowing out of the stock market into the safety and quality of the bond market. So even though the fundamentals are negative for bonds, the short-term liquidity is showing money flowing into the bond market and therefore not moving up as much as it could. So take a look at the 10-year Treasury. That's the blue line. You can see more volatile, but it's suggesting much higher yields, probably closer to 2% instead of it was about 178 most of the time this week. Let's call it 180, close enough. But so look for yields to grind higher, not explode higher. Now the dollar has really exploded with the Fed coming out and saying, oh, we're going to raise interest rates. And with the U.S. economy stronger than every place else, you really have to be short the euro. That's the place to be, not in the yen. Gold finally cracked under the pressure of the strong dollar, under the higher real interest rates. These are all bearish factors for gold. So I keep wanting to get long gold because of inflation, but interest rates went up faster than inflation. Therefore, real interest rates got worse for the gold market. So bye-bye gold. Our gold indicators, negative, bullish, negative, 2 bearish, 1 bullish. So we're not looking for a major collapse-o-rama. We're looking for a grind lower. Crude oil has continued to move to new highs. We've got up to 89. Everybody's talking $100 oil, but, they're talking their position, so I don't want to listen to the people in the industry. But it certainly seems like 90 is where we're going. And Bitcoin stabilized somewhat, but notice the purple predictor. The purple predictor continued to move lower, and that suggests to me that this is just a little pause that refreshes, and it's going to start to collapse again. So we don't want to be in Bitcoin at all. All right, thank you, freebies. Love having you on here. And of course, you should, of course, become a fully paid up member and get way more analysis and specific ways, the specific trades that I'm putting on. In other words, Wall Street Winners doesn't cost anybody. It pays you money to subscribe.